To oversimplify it for me, 2017 looked like it was a good year for housing. 2018 looked like it was a bad year for housing. What are you expecting in 2019?
I think it'll be a pretty good year for housing. How's that? I mean, we're not going to shoot the lights off in the housing market this year. There is this disparity between price increases and wage growth, and it's entirely tied to inventory. That has not changed going into this year. We are still undersupplied as a nation. What's changed is it's going to look a little murky. We'll see pick up in inventory, but we'll see it at the higher end of the market. It's not where the demand is, which is for starter homes, new home buyers, millennials. And so housing, what I like to think of it, it's bruised but not broken. There are still some bruised spots in the housing market that only regulation will fix, and that will drive inventory forward. But it will continue to limp along pretty well because of these lower interest rates and a patient Fed.
Meanwhile, Michelle, some of the construction stocks have been like crushing it because we haven't been building that much. Do you agree, like we're limping along here, but short term you could see something?
Yeah, I think to Nela's point, it's a bifurcated market. So where on balance, inventory levels are still pretty low, where we probably overbuilt, as Nela said, was in the luxury part of the market. And now where there's opportunity is the more affordable first-time home buying part of the market. But builders also have to contend with the fact that labor costs are high. Construction wages have continued to rise. And pricing power might not be as supportive as it has been in the past in terms of their ability to actually continue to push home prices higher, given this divergence with income growth.
So, Nela, given your version of your view of the market, is this a good time to invest in home building stocks?
Yes, it is. It is a good time because of the rates are so low and because we expect, that building will catch up to where demand is. If demand was weaker, if we saw demand falling off, if we saw a big downturn in purchase applications, for example, if we saw a big increase in interest rates, then the housing market would be much more vulnerable. But we're not seeing those things now. We still expect growth to continue. Growth is good news for the housing market. And so in that sense, the outlook is pretty good. But there are these headwinds that are significant for housing long term, and that should be part of the real estate investment strategy as well. How does the industry handle these headwinds that Michelle mentioned? Labor costs, land zoning. That's part of housing's future as well.
Well, that's one of the issues, Michelle, because as we talk to home builders, they say one of the problems with building catching up with demand is they just can't get the workers.
Yeah.
Well, if you have to pay a lot more for the workers, that's going to affect the price of the house.
That's exactly right. And what they're going to try to do is if their costs are going up, they're going to try to increase the price of the home. But what we're seeing now is that there's some frictions now where you don't have as much pricing power because prices have exceeded income to such an extreme. One of the things that we look at is new home prices versus existing home prices throughout the recovery. And the story is actually very interesting. The ratio between new home prices and existing home prices got to very, very high levels. Builders were trying to build to the areas where they had pricing power, more of the luxury homes. As they're moving down, as they don't have as much pricing power, you're going to see those ratios come down, and it's not going to be as attractive.
So, Nela, you mentioned sort of a backstop of government help to sort of jumpstart the housing market as well. What in particular really stands out to you?
In terms of help from the government, I think it's really the local government. It's regulation. We know that zoning costs, the fact that a lot of these cities are zoned single family, really pushes up the cost of building a house. But moreover, it's also tied to these macro issues that the market as a whole is struggling with. Tariffs impact housing. What we've seen in terms of lumber and steel tariffs have increased the price of new construction. Immigration affects housing because a lot of construction workers come from other countries, and Mexico. The fact that we don't have short-term visas in this country to draw in that labor and lower the price of building a home in this country. So this is a global market, even for the most domestic of assets, which is a house. And so it is part and parcel with all the other policy initiatives that are weighing on stock markets right now.
And that's definitely sort of a structural view versus short-term 30-year mortgage rates have moved lower. Michelle,
absolutely.
What do you think about that?
I think Nela is absolutely right. I mean, there's these bigger factors that are going to be influencing what that break-even level of housing might be. So when you look at the simple math and you think about the population dynamics, you can come up with a household formation rate that would yield about 1.5 million housing starts on aggregate as the break-even. And that's what we used to think historically, but it doesn't seem like that's the case anymore. Right. It seems like it's going to be something lower than that because you have these dynamics that have impacted how high supply might be able to go. And then at the same time, you have structural dynamics that have also impacted the equilibrium rate for household formation as well, and that's kept it lower. So we're talking about lower break-evens for housing now.